You are listening to the Practicing the Art of Small Business podcast with Shannyn Merlo and Julie Parker. Join their conversation about business, leadership, and the self-awareness journey to greater success.
Welcome, Julie and listeners, to episode number 24 of Practicing the Art of Small Business. Julie, how are you?
Really super. Thanks so much for asking, Shannyn. I know I always say that with an American or Canadian accent, but that's how it was asked. It was told to me many years ago when I worked with the beautiful Olga, and she was from Canada, and she was ridiculously polite because apparently that's what they're known for, being ridiculously polite. And I'd say, "Hi, Olga, how are you today?" And she'd say, "I'm really great. Thanks so much for asking." And so it stuck with me because I love it.
Oh, well, I love asking and I love hearing how you're doing. Now, we are at episode 24. If you're following along in sequential order of our podcasts, do not be confused because the last episode that we did was episode number 22.
Yeah.
Because episode number 23 is after episode number 16. And now we're jumped ahead to episode 24. Really, the numbers are just for Julie and my references more than for you, dear listeners. So just enjoy the ride. Don't be too concerned. If you haven't listened to episode 23, go back and listen to that and you'll see why it's out of sequence. And plus, Julie and I just like to make things up as we go along. That's
it. As you said, you've said on more than one occasion over these episodes, there are no rules, and there are no rules. It's like Thunderdome.
Well, hang on. Can I change it, Julie, and say there are rules, but we're allowed to break them.
Oh, yo. That's it, baby. Well done. That's what living in society is all about, breaking those rules. The thing where it takes you. What are we talking about today, Shan?
Well, Julie, we are talking about something that probably has some rules around it, to be fair. We are talking all about cash flow and money. In our episode 23, we were talking about balancing in the podcast between the mindset, personal development side and the more technical side of running the business. I actually think in this episode, we're going to combine both because we want to talk the metrics of cash flow and some ideas of how we can help people manage their cash flow better. But we can also talk a little bit around the mindset of money and also the mindset around how to manage your cash flow. So I reckon we can combine in this little episode today.
Wow, this seems really exciting.
Let's see where we get to.
Let's get going. Well, why don't you get the ball rolling, Shan?
I like a rolling ball. So yes, I shall. I want to talk cash flow because let's be honest, if you don't have a business, that's how your business goes into liquidation. It's pretty simple. We know that I don't know what the stats are, and I should have looked it up. Is it like 60% of businesses fail within the first 3 years and 80% in the first 5 years?
Yeah, that sounds right.
Guess why? And fail is an interesting word, but the reason why they fail, it all comes down to not making enough money to pay the bills that you are spending money on and having enough money to pay people and yourself and to keep going. It's not so much that you just made a decision and shut the good doors because you had something better to do. It's more that the business has failed. So we want to support you guys who are listening to manage your money better in your business so that you can get past that 3, 5, and 10-year itches.
Yeah, I do remember coming up to the 5-year mark of my first business and going, woohoo, still running. I've achieved something in my life.
Woohoo. So the other reason this came up is I'm going to use an example of ABC Corp.
Oh, that's your secret code for a client you may have possibly worked with in the past.
May or may not have. Maybe making them up. Who knows?
I like it.
Who knows? And the director of ABC Corp has given an indication that the revenue, money coming in, is, let's say, about 200,000, and the expenses going out is about 100 and, let's make this up because I'm making it up, ABC Corp, 160,000.
Yeah.
And we can say that's a month or a year, it doesn't matter. Technically, they should be having $40,000 in profit. If anyone wants to do the maths, that was 200,000 minus 160,000, 40,000. It's important to show you're working.
Thank you so much for not making those figures more complicated than they needed to be.
$21,342.10.
The expenses are?
No. So off the top of their head, director of ABC Corp should be making 40,000 in profit, yet they have no cash. So what's going on? Let's unpack how this works. Mm-hmm. Let's talk about the things that a lot of people forget to consider when they're making money in their business. And let's see if we can't come out of this podcast with some helpful suggestions for people to check in with. Noting, however, there's a big disclaimer on this. We are not financial advisors. We are not tax advisors. This is very general in nature, and really you must talk to your accountant before making any financial changes in your business.
Neither of us have even worked as a teller in a bank. Like, we've barely been to an ATM. We really don't know what we're talking about.
I would be able to if you only gave me figures in like tens.
Big round figures.
If you gave me 231,432 and 10 cents and I had to do maths, I wouldn't with that. No.
So why would this business, Shannyn, not be seeing that 40 grand in the bank? I've got to say, this calls back to when I first owned my first business, which was a dental surgery. And I remember my comment to my younger sister, who was my bookkeeper, and my accountant, the fantastic Daz, who's my Darren, who's my accountant, saying to him constantly, at the end of a profit and loss report or at the end of the profit and loss report for the whole year, where the hell is that cash? It's not in my bank account. Where the hell is it? Shannyn, where is it?
Okay. So what would happen if I told you that was, off the top of their head, director's head, and when I looked at the P&L over the past 3 months, there had been negative cash flow in that they weren't actually doing the equivalent of $200,000 in revenue. They were doing, in fact, let's say $150,000 in revenue, but their expenses were still $160,000 in revenue. So I think that what sometimes happens is there's a monthly bias to what we think we're earning, or a future bias to what we think we're going to earn. And our expenses may actually be, our expenses are normally, in theory, what is going out, but we're more optimistic about what's going in, or we're looking into the future of what we think we're going to get, but we're not actually tracking our expenses. So one of the things that often happens is there's this idea around, I'm pretty sure it's close to 200,000. I know roughly what my expenses are, but if there's been a couple of months, especially around Christmas time, I know a lot of actual clients, not ABC Corp, do have a bit of a downturn in December, January, and even February. So you've got 3 months of cash flow that can be impacted, and especially around Christmas, because you're paying out leave loadings to your employees. So your expenses go up. And so you can have negative cash flow for a couple of months that then impact your cash. So it's a starting point. What are your thoughts on that as a starting point?
I agree. I think one of the best things you can do, even if you don't understand the figures, and a lot of entrepreneurs, let's face it, we don't understand the figures. Yeah. Even if you don't understand the figures and you feel like your meeting with your accountant goes out with you feeling a bit more confused than you walked in, just stick with it. The penny will start to drop at some point. Get an accountant and bookkeeper that are really happy to, educate you a little bit around the figures, but just start tracking those profit and loss reports as soon as you can. If you haven't tracked them in the past, drag them out of the system, out of the MyOb or the whatever, and start plotting down so you can see the trends. Income always goes up here and down there. People pay their accounts really well in these months, but not so much these months. And recognize, when super comes out, for example, that may not come out every month, that might come out every quarter instead. You may have these fluctuations in bills that are quite substantial, and you just need to start to understand that. So plotting them down in an Excel document so you can and then convert it to a line graph, even just so you can see it. If you're a visual person, you can see the line graph document of, this is what I need to plan for coming up in the future, so it doesn't hit you with a bit of a shock that you go, all of a sudden my bank account's gone and taken a big dive.
Yep. Now there's a couple of other things that we want to think about, because what doesn't appear in your profit and loss is tax, and also any liabilities related to loans. So what ABC Corp have also done is, because they did have a couple of months where they were actually earning over that 200,000 mark, Mr. ABC Corp director was like, woohoo, we got cash to burn. So let's burn it on these assets. Let's take out some loans. But the loans haven't been considered in the P&L because it doesn't sit in your P&L. And therefore, although you might have a couple of thousand, up to $10,000 a month going out of that $200,000, that isn't actually on your P&L. So we want to take into consideration that. And also your tax liabilities. So that doesn't actually sit on your balance sheet, it does sit on your balance sheet, but it doesn't sit on your profit and loss. So one of the things that comes up, and also probably the other thing, is money that you've taken out as a director doesn't sit on your profit and loss. So if you've done director's drawings, you may be paying yourself a wage, but on top of the wage, you might pull money out, which is your profit. Now, if you do that, but it's not technically profit, then you're going to be in a negative cash flow scenario, but it's not actually going to show on your profit and loss. So you're scratching your head going, I got paid 200,000. I paid out 160,000, but there's not $40,000 sitting in the bank account. What's happened? This is where you want to be looking at your, what other money is going out of the account that's not actually being recorded in your P&L. And for someone who's a finance numpty, calling myself a numpty, that this is something that I'm like, this makes sense to people who know finance and know accounting, right? But I'm like, if I'm using my P&L to kind of project what my budget's in the future and things like that, I'm going to forget. I'm going to forget that I have to pay tax. I'm going to forget that I've got to actually pay PAYG. Even if you're a solopreneur, you've got to be taking into consideration your PAYG installments. So I think that knowing what is and isn't included in your P&L is really important to work out where your cash is.
For sure. And the first person that we ever kind of take on the services on a regular basis or employ to a certain degree, even though they're a kind of a contractor arrangement, is going to be an accountant. And I would really suggest a bookkeeper as well, because the cost to your business to get them to do what they do best and to sit with you, every half year with your accountant. And I always say sit with your bookkeeper every quarter, just to make sure that you're sticking to the projections, that we're still turning over what we were hoping to turn over, that expenses aren't going to be fluctuating. If they are, you understand. And so they are this source of information for you, which is absolutely crucial when it comes to looking at the amount in your account and going, I'm just going to spend that because I got it. Or at the end of the leading up to the end of the financial year, I really want to boost up my expenses, so I reduce down my taxable income. You got to figure out what your taxable income is to start off with before you can start spending all that money out as well. So having those regular, as I say, quarterly meetings with your bookkeeper, every half year sit down with your tax accountant, I think is such an important thing to do. Money well spent, as they say.
Julie, do you go through the finances of your clients? Like, do you sit down and actually do financial?
I make a contribution, and so I sit there, and this because I do really strongly urge every 6 months a financial meeting. I sit there with the bookkeeper, and the owners, and then I have a lot of my input is the growth of the business and projecting what's going to happen after we make certain changes within the business. But certainly all of the tax implications and all the rest of it, I don't even touch it because, one, I'm not interested, two, I don't understand it, and three, there's someone more qualified in the room to do that for me.
100%. The reason I asked the question also is because your point around having an accountant and a bookkeeper that you can rely on is a great point, but you don't know what you don't know. So one of the challenges, I changed accountant bookkeeper last year because I knew that I had liabilities coming up, and my accountant and bookkeeper were silent. I was like, hang on, if you aren't reminding me of something that I'm aware of, what are you not reminding me of? What are you not reminding me of what I'm not aware of? And then when I've changed, I've come to realize the difference in the models that I had before and after. I do think that, and ABC Corp director only realized that they were not getting what they needed from their bookkeeper and accountant when Shannyn looks at the P&L and the balance sheet and says, this doesn't make any sense. Why is this here? Why is that not there? Why are we not reporting on this? Why did you not get any COVID benefits or grants? What was your accountant doing? So I think that coaches do have a part to play, yes, in the forward projection of money, but also poking the bear of saying, are you being supported by your accountant? Did you pick up the phone to your accountant before you made that capital expense, before you bought that big shiny thing? Because did you have the money? Was it financed in the right way to support the tax implications? I can't answer that question. I'm not going to go anywhere near that question. But I think making sure that you do have an accountant and a bookkeeper that you can pick up the phone to and ask the questions is so important in a growing business. And if you don't feel comfortable, if you don't know what your accountant or bookkeeper are telling you, if it doesn't make sense, your point is well made, Julie, to kind of keep asking them and stay with it. But actually don't stay with the accountant and bookkeeper if there's a question about their value to your business. What are your thoughts?
I think I've got a couple of things to mention about that, because quite often what I've witnessed, I never did this because I'm always the first one to put my hand up and say, I don't understand. And I have this running joke with my accountant. When he says something that I don't understand, I said, you're going to have to get the crayons out and go slow.
Where I say, talk to me like I'm an idiot. Because talk to me like I'm stupid.
Pretend I'm 5.
The thing that I always get caught up in is the negative assets and the positive, the negative liabilities and the negative, like
I can tell you understand it well. I will lend you my crayons. You can take it with you to your next accountant visit.
So like, hang on, if a liability is in brackets, that means it's no longer a liability. Is that right? Because it's a positive liability. How do you have a positive liability? And then the accountant gets into, and it's like, I don't understand. You got to talk to me.
No, the other point I was going to make was that we need to take responsibility. Even if we don't understand everything that's going on, explain it to a point where I might be able to understand it, and then there's an accumulation of knowledge and awareness as well. But to never put the business direction, the business decisions, the financial decisions on the shoulders of the accountant. There's a client that I remember from my past that said, if the accountant says we can afford it, we can afford it. I'm like, no way, man. Like, you have to take responsibility for that. For one, it's not fair to the accountant if that purchase was bad and then you turn around and say to the accountant, but you told me it was good. You've got to really maintain your sense of responsibility. It's your business. It's your money, Ralph. And you are getting data and advice from the people around you, from the bookkeeper, from the accountant, from your friends, your family, your other mentor, everybody else that's in your circle. It's just all data for you to move through and research, and then you come up with your decision at the end of the day. And so I think sometimes it's very easy to blame the accountant, but if you're taking complete responsibility and actually putting your hand up and saying, I don't understand it when you say that, I need to understand this because I'm about to spend $100,000 on something, then you've really got to make sure that you're the one driving that boat and utilizing your accountant in the capacity that they've got power.
Mm-hmm. I think that asking questions and taking responsibility are great points. One thing, the taking responsibility, a little story, and this is my contribution to understanding financial reports. I had a client, I still have this client, but I have a client who said to me, Shannyn, I don't understand. What's the balance sheet do? I don't understand this. And I always ask the accountant, and I just don't get it. I don't understand why I'm looking at this. And my response,
why are you passing this piece of paper to me? I don't understand.
I don't understand. And the beauty of him asking me this question as a finance finance numpty is I was actually able to explain it in stupid language.
In numpty language.
In numpty language. So the balance sheet, this is learning, but, I'm sure an accountant will tell me that this isn't correct, but that's okay. But the balance sheet is essentially your poop report. And I said this to my client, and he just looked at me like, what? What is a poop report? I'm sorry, there's going to be an expletive in this. The poop report is the amount of money that you have at the end, or what you owe, if it all turns to shit and you have to sell up. So it's not if you sell your business, it's sell your assets and pay off your liabilities. That's the amount of money that's left at the end of the day. So at any given time, it gives you an indication of the overall health of your business. Now, obviously, if you've got some loans out at the moment, if you've made a capital expenditure, listen to me with my finance wordings.
Capital expenditure.
Then you're going to owe quite a bit of money on that particular item. However, noting that it will actually sit in an asset, so when you sell it, it should even itself out. So that, you want to actually be aware of what your health is. Now, how do you end up with a negative on your balance sheet or your poop report? Well, you owe more than what is owed to you, and more than what you own.
You have more liabilities than you do assets.
Correct.
So it's just like a little scales, isn't it? Assets on this side, liability on this side. Which one's up? Which one's down?
Yeah, but I like poop report.
Oh, poop report's good. I like it. No, I wasn't saying I don't like the poop report. I love poop. I love pooping. makes me feel better when I'm pooping.
So what strategies do you suggest, or do you utilize? Probably more importantly, let's just work off our own experiences. What strategies do you utilize, Julie, to help manage your cash flow? Okay. All right. Well, how about I answer the question first? Julie uses fairy dust to manage her cash flow.
Gosh, you make me sound like I've got a complete handle on it. Let me just access my Excel reporting system and work out all of my cash flow projections. So certainly when I owned my own dental practice, and what I do with my client dental practices now is wildly different to what I do with my own personal business, this new business, not new business of mine, but it's quite different business to owning a dental practice. So the strategies that I used and what I promote to my clients and encourage them to do is key performance indicator reporting. And one of the key performance indicators is the monthly result of the P&L. And there's revenue coming in and all of the expenses going out, of course, which is the P&L report. But all the other key performance indicators are looking at the influencing factors to revenue. So how you make your money, how many are buying, how your promotions are going to help get people to buy, and all the things that go into influencing that revenue. And of course, the KPI reporting, you're doing that every single month, and you really need either the business owner, the small business owner, or somebody doing it for the small business owner, but then delivering it to them, they need to go through that every single month. Have a look at that and think what's influencing what, and try, even if you don't understand it at the start and you can't see trends or you can't see patterns at the start, you start to see trends and patterns. And I can't tell you, I mean, I go through a number, there's 12 key performance indicators that I do get dental practices to track. I can't tell you how important those figures become, not just on a monthly basis, but if they want to, let's relocate to another practice, what's going to happen? That person's going on holidays, what's going to happen? You can very quickly make determinations and shift the projection round for the coming year to be really quite accurate. And if you're going to do something for growth, you can project those figures out quite easily. Once you start having that backlog of figures that you can reflect back on, it's really quite impactful. So the key performance indicator tracking every month, every 3 months, sitting down with the bookkeeper, so you start to go, oh, that's right, super does come out every 3 months, and oh, that's right, we've got BAS due every 3 months and all that sort of stuff. And then every 6 months having the financial meeting with the accountant, the bookkeeper, and yourself, and anybody else who is kind of a leader in the organisation to participate in that. They were the ways that I tracked my business.
Okay. I do want to make a point before I talk about what I use in my business, and it has helped me monumentally, is we talk revenue quite a lot, but revenue means absolutely nothing if we're not talking about profit. So if I was just talking about ABC Corp and their revenue of 200,000, and let's call it monthly, a lot of people are like 200,000 a month, that's fantastic. But with their expenses of 160,000 and their tax liabilities and their loan liabilities, they're at $220,000 worth of expenses of money going out each month. Now, that is not a profitable business, and that cannot be sustained long term. So I really encourage people to focus not just on revenue, but on profit. And the way to make profit is to spend less money than what you're making. It's pretty simple. There's also a very important to also note that if you are doing director's drawings, and I've actually experienced this with clients that I've worked with, where it's sort of like, oh, we've got heaps of money in the account, we'll just draw that out as director's drawings because, we can, but then not actually paying liabilities. And so like, well, you can't spend that. Oh, no, I can because it was sitting there in the account. It's like, no, but you can't because that's actually owed to people. So then they've got ATO debts and things like that because they've drawn out cash that they thought was theirs. So really important to be aware of the profit and to be aware of it, to maybe set structures around profit drawings so that there's not that tendency to just pull money out of the accounts just because it's there.
And I would imagine that, and obviously I think budgeting is a must, that make a budget for the coming year for all of your expenses. So this is how much we're going to, for a dental surgery, for example, this is how much we're spending every month. This is our budget every month for consumables. This is our budget every month for equipment repairs and maintenance and new smaller pieces of equipment that we're bringing in. This is our wages budget, etc. Marketing, promotions budget. And then anything outside what has been budgeted for, which is over a certain dollar figure, I think all of those questions have to go through the accountant and or bookkeeper.
Absolutely. So one of the ways that one of the things that supported my business, and I think that there is an opportunity for businesses to make a decision or to investigate this and see whether it suits them, is there's a book, and I say this with the caveat of that I'm not telling you how to run your business by a book, but this book actually helped me a lot to set disciplines around cash flow and saving money in my business, and setting discipline for me to not pull money out of the business just because it was there. So if you are in specifically early stage business, 1 to 5 years, and you haven't got your cash flow sorted yet, I strongly encourage you to read Profit First by Mike Malkowitz. It's super easy. If you've done Barefoot Investor or read Barefoot Investor, for your personal finances, it's pretty much the same. It's bucket accounting. But what it does do is it sets the discipline of when you've got income coming into your business, you then percentage-wise extract certain percentages into separate accounts. There's a tax account, there's a vault or reserves account, there's a profit account, and there's a couple of other different ones. But what it does do is set discipline around each month I'm pulling a certain percentage into tax, and that covers off my GST, and it covers off my company tax if you're a company, and it covers off my PAYG requirements. That money cannot be spent. So I think that there's often a bit of a mindset around, oh, I'm seeing,
it's all my money.
Look at all my money. I'm seeing.
Yeah, if it's in the bank account, it's unspent money.
Yeah. So now I can pull that out as director's drawings, or I might buy a new shiny thing because it's there. If it's sitting in the tax account, you can't. That is owned by the government. Now, this might not feel very comfortable for a lot of people, but I tell you what, if the ATO sends you a note and you've got a massive tax liability, that's going to create a fair amount of stress, and it's going to impact your cash flow, because that then becomes a liability on top of your existing liabilities that you need to pay to the tax office. So it works really well in terms of disciplining to save for tax expenses. It sets accountability, or it sets good discipline around actually having profits sitting in the bank account and only drawing on that under criteria that you have defined, not just because you feel like it. And certainly setting up money to have reserves. The number of businesses that don't have any reserves sitting in their business is actually really scary. And when we talk about those businesses that have the downturns in December, January, February, you want to have enough reserves that support your expenses, your standard expenses during that time, so that you can actually go away on holidays and know that the money's actually sitting there. The school of thought, depending on how much revenue your business actually has, is to have 3 months worth of your standard expenditure sitting in a reserves account. So you've got that sitting there. And the reason why this is beneficial is it just takes away money stress. So I use a component of Profit First. I was using it pretty heavily in my business. I've restructured things for my benefit now. But I still use the approach of income coming in and extracting out. It also means that your operating expenses account stays really lean. You only spend from your operating expenses account. And if the money's not there, you cannot spend it. So really one of the foundations of Profit First is that you keep your operating expenses account lean so that you don't go and spend the money. Have you heard of Profit First or Barefoot Investor, Julie?
I haven't, but is that guy Mike McCowood? Is he the same guy that did the pumpkin book?
Yeah, he did.
Yeah.
And the toilet paper entrepreneur and a few others. The Profit First one's the one that really resonated with me, and I literally read it in a day and implemented the Profit First thing in a day. It was super simple, but I'm not a complex entity. I would encourage you to talk to your accountant first. However, my accountant wasn't completely on board with what I was doing when I went over, and that accountant was like, is this really useful? And I'm like, yes, it is, because I've got discipline around how I spend my money now, and it's important for me to hold that discipline and to have the mindset around where the money is going and what I'm spending it on, so that I'm not spending more than what's coming in the top.
Yeah, I think getting, as a business owner, as an entrepreneur, to ask the question of your fellow entrepreneurs who are in your circle or in the whatever Facebook group that you're part of, ask other people how they manage their money, because it does come down to utilising a system that works well for you. Like with me, having the thought of all those different accounts, like, I don't think so.
I won't tell you how many accounts I've got between my personal and my business.
How many do you have? I want you to
tell you.
I'm gonna demand you tell me.
I've taken it down to 13.
Oh. You see, that works beautifully for you. That's great.
Well, it's because I've got Profit First in the business, which has like 8 accounts attached to it. And some of them are pass-through accounts. And I'm also doing a combination of Barefoot Investor and the Shannyn method.
I can't wait for your book to come out. It's going to be quite the volume.
It's just basically squirreling money away into tiny little places. So if you wonder whether Shannyn, when Shannon's talking about I can't afford to have that coffee, it's because there's money squirreled away in lots of different locations.
She's got jars, the equivalent of jars all around her home. I do like your point before around 3 months worth of expenses put aside. That's one of the most crucial things you can do. If COVID has certainly brought home very severely for some businesses that your income may be dropped to its knees within hours and your projections out the window. And it's one of the most damaging elements of these lockdowns is that poor business owners are trying to navigate through this and actually hold on to their livelihoods. And the thing with that 3 month worth of expenses is that after 3 months of non-payment, your electricity will be turned off. Your landlord will kick you out. Your staff members way before 3 months will stop working for you. And so I think having that 3 months worth of buffer is a crucial thing to have.
And look, I don't know what accountants would say about that. If your revenues, if you've got $600,000 sitting in your account just hanging out there, and I'm sure that there's better ways to utilize that money. The reality of it is, though, that if they say save on tax and spend that money, well, what happens if you have the downturn? What happens if your biggest client who is contributing 30% or 40% of your revenue, it happens, goes out of business? Client of mine, their 3 biggest clients went out of business within a 6 month period, a $4 million business, and had to liquidate. It happens.
Yeah.
So you want to have that 600,000 sitting around to be able to keep you afloat, so you can find those clients if they drop off.
And I say, like with the dental surgery, for example, you are relying on hundreds to thousands of clients contributing to your revenue every single year. So you don't have that heavy reliance on just 1 or 2 major clients. If you are a business that you really do rely heavily on your 1 or 2 major clients to be able to even survive, then I would suggest that having a plan B ready to go at some point is a big step towards your long-term viability, just in case the worst thing happened.
Yeah, look, that probably gets into a whole other kind of risk management scenario. Although I do think that people get comfortable with the golden goose client. And it's just easy, and it's like, yeah, but they're there. And I know I've worked with a number of clients where I'm like, so let's find some other clients just in case. Oh, no, yes, it's important, but, the enthusiasm to find clients to fill that spot in case they drop off isn't always there, because, yeah, it's the golden goose. So we've talked a lot of technical, and I'm looking at the time, Julie. Do we want to do a quick little chat around mindset around money, or should we do that as a separate episode? If you guys, by the way, if you haven't watched us on YouTube, please do, because Julie and I are on YouTube, and we are interacting, and Julie just looked up and gave me a stare like,
I have no opinion about that kind of stare. I think let's not leave people hanging. We can go into it more. So we want to talk about, mindset around different things in the future as well. But I'm intrigued as to what your initial thoughts around mindset of money is. If you've got one thought, is. If you have many thoughts, are.
And thank you for your English lesson. I appreciate you helping me out.
Anytime.
As most of you, if you're a frequent listener, I struggle with English and maths. So
like it's a second language.
I think what I want to talk about in regard to mindset is mindset around your business financials here, because I think mindset around money is a huge topic that we can go deep on. I want to talk about the mechanisms of what happens in the brain. And we've talked about this in this podcast. If you see a bucket of money in your account, are you the kind of person who says, "Oh, I've got a bucket of money. I've got to spend that money." And therefore, when you get 3 months down the track and you're like, "Oh, I've got no money. What happened to my money?" You can go back to that idea of like, "Oh, cash monies." So the mindset around saving money in your business for rainy days, that cash reserves, or for actually making capital expenditure, instead of getting a loan to pay for items, saving to pay for items. So what you might do in your personal life. I think that depending on how you spend money in your personal life can be how you spend money in your business life. If you're employing people, you absolutely cannot do that. You've got a responsibility to your team to make sure that you are financially viable and you've got enough reserves to sit there to support your business, because people rely on you to feed their families. Like, not to put too much of a spin on it, but it's really important. So you going in and spending money just because it's there isn't actually going to help you. It's not going to help you sleep at night. It's not going to help your business be sustainable. So I think having a look at your disciplines around how you manage your money in your business is really important. If you do have really high expenses because you're, I don't know, I'm just trying to think of a really outlandish expense, like
doing a facelift of the internals of your office while you're still just struggling to achieve viability.
Oh yeah,
just making things look pretty.
Oh yeah, brand new computer because I need it. To be fair, my computer is actually just kind of getting nudged over the line at the moment, but I know I've got to buy a new laptop. I know I want to save for that laptop. I actually want to save for it so it's sitting there. I don't want to take a loan for that laptop, and I should have that sitting in the reserves knowing that it was my budget. I haven't squirreled that away yet. But
that's another jar. That's another account. I'm so excited.
I need a laptop jar.
And so you're right. There is a mindset that we have in our personal funds, our personal spending. We need to really develop our own business money mindset, don't we?
Yeah. Well, especially if it's not supporting you, if it's not supporting the business.
Because I think another mindset around business money that doesn't support you and doesn't support long-term viability and growth sometimes is the aversion to debt. In my personal life, this has never been me, by the way. In my personal life, I hate debt. Debt's a bad thing. I was brought up that debt's a bad thing. You have to save your money first and then buy the thing once you've got the money for the thing. But in business, quite often, debt helps you grow. It's your vehicle for growth and development. Yeah. And completely manageable within the business.
Yeah, absolutely. That would be definitely one I'd talk to the accountant about, being able to afford the loans. But yeah, I completely agree that looking at your relationship to money generally is really going to help you understand what's inhibiting your business. But it does go deeper, because what you charge can actually, especially if you're a service-based business, can be impacted by the value that you place on money. If you've got
that's another discussion too, isn't it? What do you charge for your thing? When there's the school of thought, and I've recently moved through this as well over the last couple of years, you make the irresistible offer, make it a no-brainer. Of course I'm going to buy that thing because it's so cheap and it's obvious value, as opposed to I'm not going to buy that thing. It's only that small amount of money. There mustn't be much value in that. And so then you can flip to the other side and say, buy this thing. It's so valuable. I'm charging top dollar for that. That's a great topic for the future. I'm going to write that down on my piece of paper.
That's a great idea to write that down. I mean, it goes into the conversation, Julie, that you and I had before we started this, where I currently have a cohort of people in a program, and it's a test program. And I actually felt more comfortable offering it for free because it wasn't a complete program yet. And I was getting caught up in perfectionism. I didn't see that there was going to be value if it's not perfect. And because it wasn't perfect, I wasn't selling it. And so there's a whole bunch of stuff around our perceived value. Also, perceived value is a really interesting thing. What I value is not necessarily what you're going to value, Julie. I know I've
That's
got
for
clients.
sure. That's for sure.
Have you had conversations with clients where you've gone, I don't think that went really well, and they walked out going, oh my God, that was amazing. That's life transforming for me. And you're like, really?
I have that all the time, Shannyn, all the time. And I think too, it's worthy of recognizing, yes, this is a cash flow discussion, and we're talking a little bit about the mindset around things too, but always that awareness around all the assets of the business as well. You're talking about the balance sheet being, this is what you would take away or lose in the business if you sold it today. Poop report. That's
if
right.
it all turns to shit.
That's right. That's right. So instead of the poop report going to your accountant, you'd be going to your proctologist. Hilarious. But talking about the other assets, how you can actually build in assets into the business, such as, a magnificent practice manual that goes through all the standard operating procedures, really upskilling your team members, all the other things that can go into the kind of unseen assets of the business as well, that can really start to make sure that your business is a strong entity moving forward.
That's not going to sit on your poop report, but it's really important. No. And I think it
Are you saying it's more like a fart? Nothing really tangible, but it makes a difference. It makes an impact.
I'm sorry, listeners. We've gotten swear words. We're talking proctology. We're talking digestive issues. Sorry. But you'll be pleased to know that I'm about to wrap this segment up, or this episode up. Julie, do you have anything to add before I do my little rappity rap?
No, you rap away, baby. You rap like there's been no rap done before.
All righty. All right. So in today's episode, we did talk cash flow. The important things to remember is that revenue minus the expenses that sit in your profit and loss doesn't necessarily mean profit, because it doesn't take into account other things in your business, such as paying tax. Make sure that your accountant and bookkeeper are actually on your bus. They should be able to provide you with immense information. And if you don't feel comfortable picking up the phone and getting clear information from your accountant to be able to make business decisions, maybe have a look for a new one. Take responsibility for the money in your business and for your learnings around finances. The main reason why businesses close or fail is because cash flow. There's not enough money coming in to cater to the amount of money going out. It's as simple as that. So really take responsibility to upskill yourself in financial acumen. Have a list of key performance indicators that drive profitability in your business, not just revenue. So revenue is one element, but also profitability in the business. Consider looking at, or just my little thing is profit first. I think it's been really valuable in building discipline for me around bucket maths and squirreling money away. Julie definitely recommends 3 monthly meetings with your bookkeeper and 6 monthly finance meetings with your accountant. 3 months of expenses put aside for downturns. And think about the mindset that you have around having money either in your business or not enough money in your business, and start to unpack the beliefs that you have around money and how it might be impacting the way that you operate. That was episode number 24.
Yet again, another beautiful summary, another insightful episode. I thank you, Shannyn.
Shannyn.
That's marvelous. And so I'm going to see you next time for episode number 25.
You are going to see me next time for episode number 25.
Quarter of a century.
Oh, look at us.
That means that we're probably halfway through the year, because this comes out every 2 weeks, not every week.
We're up to episode 17, but 18. We're releasing 17.
I beg your pardon, that's right.
It's actually the 18. And if we were doing this with the financials, this is 25 minus 18 is 7 is our profit. We've got 7 episodes of profit.
Congratulations on confusing the audience as a finale effort to the episode.
I'll put the workings in the show notes.
Thanks, Shannyn. See you next time.
Thanks, Julie. Thanks, listeners. Speak to you soon.